Have you ever wondered why, in our digital age, central banks still hoard tons of gold? It's a question that often puzzles, especially since gold no longer backs our everyday money. Yet, these powerful financial institutions continue to accumulate and safeguard vast quantities of the precious metal. Understanding this paradox is crucial. It reveals gold's sophisticated, modern role, not as a relic of the past, but as a strategic component within contemporary monetary and financial systems. This analysis will delve into the objective reasons behind central banks' enduring fascination with gold. The 20th century witnessed a monumental shift in global finance. Nations progressively abandoned the gold standard, culminating in the end of the Bretton Woods system in 1971. This transition liberated currencies from direct gold convertibility, ushering in the era of fiat money. Fiat currencies derive their value from government decree, public trust, and the underlying economic output, rather than a physical commodity. This paradigm shift granted central banks unprecedented flexibility in managing monetary policy, allowing them to stimulate growth or combat inflation through interest rate adjustments and quantitative measures. However, this newfound flexibility did not eliminate economic uncertainty or systemic risks. The need for confidence in a nation's financial stability remained paramount. Gold, surprisingly, retained its relevance, albeit in a fundamentally altered capacity. Today, central banks primarily categorize gold as a strategic reserve asset. Unlike foreign currencies or government bonds, gold possesses unique characteristics that distinguish it on a central bank's balance sheet. It is often referred to as a zero-liability asset. This means gold is not a promise to pay by another entity. It carries no counterparty risk. It is not dependent on the solvency of a foreign government or the stability of another nation's economy. This intrinsic independence makes gold structurally distinct from most other assets held in official reserves. Its value is not tied to the fiscal or monetary policies of any single country. This attribute provides a crucial layer of insulation against geopolitical tensions and economic shocks, making it a unique component in a diversified reserve portfolio. Central banks maintain significant gold reserves for several well-defined, strategic reasons, reflecting a prudent approach to national financial management. These reasons extend beyond mere tradition, encompassing sophisticated risk management and confidence-building measures. Firstly, gold serves as a powerful diversifier within a central bank's reserve portfolio. Its price movements often exhibit a low or negative correlation with traditional financial assets like equities, bonds, and even major reserve currencies, particularly during periods of market stress. This characteristic makes gold an effective hedge against volatility. During economic downturns or geopolitical crises, when other assets might decline in value, gold frequently acts as a safe haven, preserving capital. This countercyclical behavior helps stabilize the overall value of a nation's foreign exchange reserves, mitigating systemic risk. Secondly, holding gold signals financial strength and stability, both domestically and internationally. A substantial gold reserve can enhance a central bank's credibility, reassuring markets and citizens about the nation's economic resilience. It acts as a tangible symbol of enduring wealth. In times of extreme economic uncertainty or a loss of faith in fiat currencies, gold can bolster public confidence. It suggests a nation possesses a fundamental, universally accepted store of value, reinforcing trust in its financial system and its ability to weather crises. Thirdly, gold's millennia-long history as a store of value and a medium of exchange cannot be overlooked. This historical continuity imbues gold with a unique psychological and cultural significance. It represents a timeless asset, transcending political and economic cycles. While not directly backing modern currencies, this deep-rooted historical role provides a psychological anchor. In moments of profound global instability, the historical perception of gold as ultimate money can offer a sense of continuity and stability, a subtle yet powerful factor for central banks. It is critical to reiterate that gold does not directly back modern fiat currencies. The days of convertibility are long past. However, its presence in central bank reserves indirectly supports confidence in a nation's currency and financial system. In times of severe economic stress or a potential crisis of confidence in a nation's ability to manage its debt or currency, gold can act as a stabilizing reference. It doesn't solve the underlying problems, but its existence on the balance sheet can reinforce trust, signaling a robust and well-managed reserve position. This role is subtle, operating more on perception and psychological reassurance than on mechanical convertibility. Despite its strategic importance, central banks unequivocally do not view gold as a replacement for modern monetary systems. Gold, by its very nature, lacks the flexibility and dynamism required for managing complex, interconnected economies. Gold cannot be easily expanded or contracted to manage interest rates, conduct open market operations, or respond swiftly to economic shocks. Its physical nature makes it cumbersome for large-scale transactions and digital payments. Modern economies demand sophisticated monetary policy tools that gold alone cannot provide, such as quantitative easing or targeted lending programs. The liquidity and divisibility of fiat currency are essential for the smooth functioning of contemporary financial systems. Gold, while valuable, simply cannot fulfill these operational requirements for day-to-day economic management. The motivations for holding gold can vary significantly among central banks globally, reflecting diverse national priorities, economic structures, and geopolitical considerations. Developed economies, with established reserve currencies, might emphasize gold's diversification benefits. Emerging market economies, on the other hand, might view gold as a means to enhance their financial independence, reduce reliance on a single reserve currency, or hedge against potential currency depreciation. Some nations might also accumulate gold as a strategic asset in response to geopolitical shifts or perceived systemic risks in the global financial architecture. These differences highlight that while gold's core attributes are universal, its specific utility is often context-dependent. Ultimately, for central banks, gold represents several key principles. Stability across time, a constant store of value through economic cycles. Independence from political obligations, a neutral asset, free from the liabilities or policy decisions of other nations. A neutral asset, a universally accepted commodity in a system built on trust and interdependencies. It is not a primary monetary policy tool, but rather a foundational reference point, a bedrock asset that underpins financial stability. Central banks do not hold gold because they anticipate an imminent collapse of the global monetary system. Instead, their gold holdings reflect a pragmatic and historically informed approach to risk management. They understand that while fiat currencies offer flexibility, they also carry inherent risks. Gold is neither an obsolete relic nor a dominant force in daily monetary operations. It occupies a specific, limited, yet strategically vital role. Its presence on central bank balance sheets is a testament to prudence, not a prediction of financial doomsday. It signifies a balanced approach to managing national wealth and ensuring long-term financial resilience. Central banks view gold not as a return to a bygone era of money, but as a critical reserve asset that provides essential diversification, bolsters confidence, and offers historical continuity. Its continued presence reflects a sophisticated understanding of risk management and the enduring value of a truly independent asset. Understanding this nuanced perspective allows us to appreciate gold's modern role clearly, without exaggeration or dismissal. In our next discussion, we will explore the recent trends in central bank gold purchases and what these movements signal about the future of global finance. Disclaimer: this content is for educational purposes only and is not financial or investment advice. Please like this video if you have enjoyed it. Every like we receive inspires us to create helpful content. Thank you once again for watching. We hope you have a blessed day.